Hello and a very warm welcome to everyone. I am Shraja and this is the first episode of Mint Insights, a new show where we take you into a deep dive conversation with an expert on a hot button topic. I'm happy to share with you that I have with me Mr. Chakri Lokpriya of TCG Asset Management, managing about $3 billion in investments. Mr. Lokpriya has about 20 years of experience working with managers like JP Morgan and BNP Paribas in the US and London. Chakri, my first question to you, and this is something which we hear from all the investors. We are entering an election year, and there is going to be brain-numbing volatility in the times to come. Do you think it kind of makes sense to stay on the sidelines for now?
It's a good point. And somewhere I read once that you say Asia performs despite its politicians. And that largely seems to be true as far as data is concerned. India has had a coalition government, not a very well-liked coalition at that point in time. But in spite of that, the stock market did well and the economy did its own thing, which was reasonably okay. So if you use that as a data point, we are probably in a very similar juncture right now. So I am actually not that overly concerned about the outcome of elections for the medium-term returns of stock market. Yes, on the day the announcement is made and the subsequent maybe month or two, the stock market does react, but thereafter it's economic fundamental.
I think there are like 3 or 4 large reasons or broader reasons that we are in a perfect storm-like conditions. One is oil, the other is rupee, the third is the election year that we spoke about, and fourth is this large IMF unravel. Do you think that what we are seeing in the bond markets in terms of liquidity crunch will also spill into the equity markets as we speak?
Well, those are lots of questions within one question, so I'll try and address each one of this. If you look at what's been happening is economic growth, while it's still been whatever 7.5%, tax collections, GST tax collections have been lower than expected. Meanwhile, commodity prices moved up. India is an import dependent country, and so around the same time when you had a lower tax collection and a higher foreign exchange outgo, it led to a widening of the current account deficit. Now on back of that, so you have a higher oil price, you have a lower rupee, and then on top of that other metals too have moved up in price, and this has increased the input cost for a number of industries, including the auto industries has a higher steel price, etc. And this has lowered the profit margins for many companies, manufacturing companies. Now, on back of that, some of the government actions of imposing long-term capital gains tax has reduced the attractiveness for foreigners into Indian equities, which has been seen evident in the FII outflows, which are at a record high for 2018. And of course, the month of September saw even greater highs. So which basically tells us that FII money is very important for the well-functioning of the Indian economy and the Indian stock market, because it provides us foreign exchange. So against this backdrop, what is the market is looking for in this perfect storm, as you call it, is growth.
But tell me one thing, that what is the reason for this panic zone? Especially when FIIs have been net sellers in September and October. Have we seen this story play out before also?
Yeah, there's this one of these thoughts that if you need to panic, be the first one to panic. Yeah, because that you hit to the exits before there is a stampede, and invariably all stock market or any market for turn out to be stampedes, because one doesn't want to be left alone in a falling market. And that is what happened in the month of September and October, early part of October. And it's no different than what happened in 2013.
FIIs have been net sellers in September and October. What do you think will make them come back?
Is confidence and growth. That's the key. The word is confidence, which FIIs have been kind of faltering because of various initiatives which were supposed to have happened, which did not happen. So it's less to do with the policy reform. There's no policy reform is needed. You have things like GST, which is done, which is a good thing. It has teething problems, but will settle down eventually. So what is needed is less regulation and let market forces decide.
Sure, but what is your sense on the corporate earnings growth? There are few spaces that are showing growth, but what about the companies at large?
See, two things. One is on the private investment cycle has not picked up, unlikely to pick up in the next maybe a year or so. So that is going to tread water. Second, consumer spending has been high but been slowing down. And then with various initiatives like Supreme Court putting an insurance tax, insurance mandatory for the auto companies, etc., has all led to a slowdown in corporate spending.
Thank you. Thank you so much, Chakri, for this. Thank you.
Thank you.